All right, so today I wanted to talk a little bit about a stock that I've started buying recently. It's pulled back a lot this year, and again, this is Paycom Software, Payc. Again, obviously a software company. Again, let's look at the exact kind of software that they provide. Cloud-based human capital management, delivered as a software as a service or SaaS. Headquartered in Oklahoma City. The firm provides functionality and data analytics. Its solution requires virtually no customization and is based on a core system of record maintenance maintained in a single database for all HCM communications, including talent acquisition, time and labor management, payroll, talent management, and human resources management applications. Again, so you get the picture there. First things first here, again, this company is down a lot on the year and again from its all-time high. This company peaked out at $547 in 2021. Ever since then, it is down just about 67%, right? So again, just crazy correction from that all-time high. Year to date, it's even down very significantly. It's down 38%. It was actually down about 50% at one point. It's corrected nice off that high. And again, honestly, this was kind of right when I started buying it, right in this area here. And again, since then, it's up nicely. This is a company that I would consider to be fairly high risk, not crazy high, but definitely, at least for me, I'm actually a little bit more conservative than a lot of people, but I would consider this to be fairly high risk for a handful of reasons that I'll get into. I mean, number one, it's a company that traditionally has traded for very high multiples, which it doesn't at the moment, but I'm sure it will again in the future. So let's get into the insights here. Everything looks very good on this company, except for, stock-based compensation is something that's extremely concerning. But you have a return on invested capital of 32%. That is insanely good. If we look at the current valuations, the 5-year average is 111 price of free cash flow. It's currently at 37. The price of sales is 6.9. 5-year average is 19. So it's way down from its historical valuations. But you also have to keep in mind that it was way overvalued, for lack of a better way of putting it, for a good part. Basically all of 2021, even a part of 2022. So again, that's something you also have to keep in mind. Honestly, I'd say price of free cash flow of 37, maybe slightly below fair value, maybe 40. Price of sales of 6.9, maybe 7 or 8, right? PE 33, right? I'd say maybe 5-10% above where it's at right now. That's probably fair value, right? At least my opinion. Again, profitability is extremely good on this company. Operating margin 27%. That's very good. Net margin 20%. The growth is just crazy good. Financial health is good. So again, let's get into the financials here so we can dig a little bit deeper here, because again, that's basically the bread and butter of what you want to look at when it comes to investing. If we look at the balance sheet here, again, balance sheets are going to be something that people are really going to have to keep an eye on going forward, because in an era of higher rates, it is harder to borrow money. So companies that don't have strong balance sheets, they're going to suffer. And a lot of these growthy tech names are going to suffer because of that, right? So again, balance sheet here is okay. 58% assets to liabilities. Again, that's decent. It could be better, definitely. If we look at let's look at the metrics here just to see how it's historically done. Again, operating cash flow margin last year, 26%, 30%. So again, they've actually been between, 26 is the lowest they've been since 2015, right? So that's maybe a tiny bit concerning. But again, if we look at the net margin, that's been pretty consistent. Free cash flow margin, that's been pretty consistent. Operating margin, that's been pretty consistent. So honestly, I'm not too concerned as far as that goes. If we look at the cash flow here, so again, the main things we're going to want to look at here is free cash flow, debt, and share issuance. And the first thing that really jumps out here is look at the free cash flow growth of this company. They've went from basically zero cash flow. In 2013, they were negative, right? To 228. again, this is ending 2022. So again, we're kind of having lagging numbers here. They haven't released 2023 yet, but still phenomenal growth, like phenomenal growth, which again is one of the reasons that I'm buying. But again, you also have to keep an eye. Debt, right? A lot of these companies, the way they grow is through debt or through share issuance, right? So again, you want to make sure that companies are growing organically, not because they're taking on debt or because they're issuing shares, because that is not sustainable, especially in a higher rate environment. So again, we look at debt issuance. They haven't taken on any new debt since, what year is that? 2016, right? They haven't taken on any new debt since 2016. They haven't issued a share since 2014. Right? So that is very good. And not only that, they've been buying back shares during that time, which is very good to see. So again, that is very encouraging to see, right? The last thing let's get into here is the free form. Let's check out the valuations. Let's check out how well they're growing, right? Again, this is very important for many reasons. The first thing, again, the first thing you'll notice here is the growth over the last 10 years. I mean, 2,200% growth to the free cash flow is just utterly insane, right? So let's go back maybe 5 years just to get a little better grasp on things here. Again, growing 20%, 22%. And again, the other thing you'll notice here, as far as the valuation, the share price appreciation has actually been negative, which is a good thing to see, which I always mention, because that means that the share price is growing not because of people simply paying more for the stock with the same levels of earnings. It's actually the opposite is happening, right? So again, if we look at the average price of free cash flow here, 218, I mean, price to operating cash flow probably would be a better way of going here now that I actually look at it a little bit, because the free cash flow has been a little bit more volatile. Operating cash flow, the average, 64. The latest, 23. The lowest it's been is 18.9, which was actually right at the start of November, which is basically when I started buying, right? So the lowest this company's been as far as valuation goes over the last 5 years is just over a month ago. So again, that is why I'm buying. I will be buying until it goes probably into the low to mid 200s, right? That probably be enough to keep it at a fair valuation, right? So again, this is I would say it's definitely higher risk because it's a company that trades at a little higher valuation. It's not crazy right now, but traditionally it has been pretty crazy. But you also have to keep in mind that they're growing very fast. So if they can maintain that growth, they'll be fine. If they can't, they won't. But given they're not growing through just issuing shares, taking on debt, that's why I'm confident, right? That's why I'm confident. So anyway, if you liked the video, please like, subscribe, comment, all that good stuff, and stay tuned for more.